Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenevec on Bloomberg Radio.
Jason Thomas, he links it all together as head of global research and investment strategy at Carlyle. And it's interesting because he actually made a very prescient call back in January, saying the run-up in big U.S. tech stocks had actually gone too far, and that was actually boosting the appeal of beleaguered European equities. Well, since he made that call, European stocks have outperformed the S&P by 9 percentage points. And it's outpaced the Mag 7 by 20. Pleased to say that Jason joins us right now. Great to see you, Jason.
Thanks for having me.
Great call. Well done.
Thank you for reminding everyone. I appreciate that.
It was a great call, and I think it's interesting, too, because it was a call that was made before we really had a clearer picture of what the tariff rollout were going to look like. We kind of knew tariffs were coming because Trump promised them on the campaign trail, but now that you have the visibility from Liberation Day and everything that's transpired in between, does that change your call at all?
Well, I don't know how much visibility we have. I think that is the big challenge today. What's remarkable about what we saw in the April data was how many management teams decided to really not be hasty, not overreact. We don't know where the tariff rates are going to end up. So as a result, it's very interesting. For the last month, we've had 25% tariffs on auto imports. Just this last week, we now have 25% tariffs on auto parts. Of course, there's very complex carve-outs and things like that.
Right.
But if you go to a dealer lot today, you don't really see any price increase. If you go to assembly factories in the United States, you don't really see any change in production schedules. And this is, I think, what we see in the economy more broadly. It's management teams, again, not wanting to overreact, not wanting to have those really tough conversations with their suppliers where they're demanding a discount, not wanting to have those tough conversations with their customers, trying to push on price.
Yeah.
Because that can burn bridges, and you find out in a month's time, policy changes, and you've made all thhave changes for no reason. And so I think that we're in this interesting period where, because of the inventory accumulation in Q1, you have a lot of companies that have months to sort of wait and see how things play out.
So you don't think that would have, in the interim, any negative impact on the economy? Things are just going to hum along?
No, I think that it's setting up for a cliff effect in some sense.
Okay.
Yeah.
Because eventually those inventories run out.
Mm-hmm. Right.
So that's my concern.
A fair amount of pull forward
in
the numbers, right?
Really, starting in December, it's intermediate goods, components, parts, raw materials, enormous increases in inventories. And of course, the intermediate goods don't count towards GDP. Mm-hmm. So that's why you had the contraction. You had a big increase in inventories on the retail side, finished products, but even larger increase in intermediate goods. And so that's what I think is going on. They're drawing down those inventories of components and parts to keep production running normally, hoping that there's some change in policy ahead, but that may not be forthcoming. I mean, to say there are a lot of loose ends here would be an understatement, of course.
Yeah, it's kind of fascinating. I just, we're just at this moment of fork in the road, right? Which way do we ultimately go? So what do you do in terms of, investors? How should they approach this? I mean, I understand this long-term investing strategy. I've heard it, our whole lives. And yet, we could be setting up for some really strong fundamental changes.
I think that these fundamental changes are something that we have to appreciate. This is a 5-year, 10-year process. And really those fundamentals are an economy for the last 20 to 30 years. Manufacturers in the United States have focused more and more product development, product design, and of course branding, leaving most of the manufacturing to the rest of the world.
Right.
So one of the really interesting aspects of this is that to reduce the trade deficit in the short term, U.S. consumers have to spend less on U.S. branded goods. I mean, think of it this way. We run about a $100 billion trade deficit in apparel and in sneakers, athletic wear, with China and Vietnam. They're not sending us Chinese or Vietnamese branded sneakers.
No.
Right.
They're not sending us Chinese or Vietnamese branded apparel. So, it's these aspects. The same thing, the deficit in semiconductors, almost entirely explained by U.S. designed semiconductors. So these are the kind of production networks and decisions that I think are going to change over time.
I want to ask you, Jason, because we've got ARM Holdings just crossing the Bloomberg terminal, and I'm going to go right to the outlook, which is something we care so much. Player is certainly in the semiconductor space. Sees first quarter revenue $1 billion to $1.1 billion. The estimate was $1.1 billion, so maybe reining it in a little bit.
Yeah.
How much importance are you right now in this moment of time putting on earnings?
Well, I think that the earnings expectations are extremely optimistic, not just for this year, but for 2026
Too
as well.
optimistic.
I think that they're going to be revised down, and I think we should be expecting that. Right now, people are expecting sort of a bump in the road in Q2, but it could be more meaningful than that. So right now, I think, again, it's both management teams and investors really focused on the optimistic outcome, that we find some landing space for tariffs that's really, not so dramatic. Again, a 10 percentage point increase in the effective tariff rate. You have some discount in import prices. You have some increase in the consumer price. You have some decline in volumes, but it's all in this manageable state space. It's really those 25% tariffs, or of course the effective embargo on goods from China. That's where you have the really significant potential economic damage. And those are the questions. When does that get resolved? Does it get resolved?
Right.
But this is a big issue for investors right now, because even if you are a long-term investor, even a short-term tactical, how are you modeling now what is effectively completely unknown to a certain extent?
Yeah.
And I do wonder, particularly in your world, as you're talking to partners and clients, is there a sense here of a retrenchment in the investing side of this equation?
Not yet. And I think that what people have learned over time is that when you sit out vintage years, or you decide that now is a bad time, that you get burned. It's almost impossible to time the markets. I think, again, we have to appreciate that this is a more or less fundamental change.
Yeah, this is a lot different than just a cycle.
Yeah.
No, that's right. And we're talking about, for 40 years, you've had a decline very steadily in the price of durable goods. Of consumer electronics, appliances, autos.
Right.
To expect that sort of price declines going forward is unrealistic.
Yeah.
Production networks are going to change. There's going to be more price pressures ahead of us.
This may be a dumb question, but the speed of which the Trump administration has come out, or at least tried to articulate these policies, if this had been more elongated, if it had been a more formal process, using real policy papers, the Federal Register, and just giving people a chance to digest things and, of course, lobby either for or against them, do you think the negative market reaction might not have been as negative?
Well, certainly, but it's also been interesting the way the market has bounced back from this. And I think what we saw in April was that there was a sense that if the market doesn't like it, or if the Treasury market starts sending some really negative signals, that policy will recalibrate. And I do think that that's what investors are banking on today. That once we get some bad data from the real economy, once the markets start to sell off aggressively, once Treasuries yields start to move up, or just a sense of more of the sell America trade, that policy will recalibrate once again. So I think that is what's interesting right now. When you have an economy where the real data look fine,
right,
when markets have rebounded, perhaps that strengthens the administration's resolve to push forward on some of these more aggressive tariff rates, and you end up in, ironically, a somewhat worse place.
But the big risk is if we read the Trump administration wrong in terms of backing off to an easier place, and that's a massive risk.
And again, with the markets rebounding, with the economy looking good, what incentive do they have? What message are they receiving that would suggest that they need to back off? I think that's the paradox right now.
All right, great stuff. Jason, thank you so much. So appreciate it. Yeah, be well. Jason Thomas, he's head of global research and investment strategy over at Carlyle, joining us.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
As the dust settles from, don't forget, we had a Fed meeting in Washington.
I know.
You had all the bankers here at Milken. They're finally starting to head home in a few minutes.
A lot of folks from the administration.
Absolutely. A lot of folks in the administration, and one person who is at the center of that. She's here right now to give us the big picture of the environment, and more importantly, some of the products that her investors are actually looking for right now in a time of tumult, if you will. Dina Dilorenzo is the president of Guggenheim Investments, $200 billion in total assets across fixed income, equity, and alt strategies. Great to see you, Dina.
Hey, Romaine. How are you?
I'm doing well. The question is, how are you? I assume your phone's been ringing off the hook the last few weeks.
I'm great, but I need to correct you on one thing.
Oh.
I have to take credit for the fact that we're not 200. billion in AUM. We're 350.
Oh my gosh! You have my soul. You have my deepest apologies. I made a mistake.
Never makes mistakes.
And Carol loves this because she loves to correct me on air. So thank you. All right, $300+ billion.
We want to take full credit for that.
How do you protect that $300 billion?
Maybe it went up just overnight. You had it right. It just boosted up.
Well, thank you for having me here.
Great
I know
to
it's
have
the
you.
Wednesday right after the conference, like last day of the conference. We're all a little raspy and winded. So I apologize if I refer to my notes today because it's been like meeting after meeting, which is fantastic because, every year you come to Milken and you want to meet with clients, prospects, colleagues, friends, the press. And this has been an extraordinary year, especially given the extent of the uncertainty, and people are just looking for clarity, conviction, and calmness from those who, provide those services to them. So the secret is keep doing what we always do, remain disciplined to our investment process, and continue to educate the clients through our thought leadership and, our commitment to them to help them work through their objectives, and if need be, refocus them into areas within their portfolio that give them that flexibility and while they balance their needs in the uncertain times.
So you're not really getting the sense that people are pulling back. It's more just looking for maybe a little bit more caution, a little bit more selectivity in things?
I think the durations have been extended, right? So we're relatively up for the year in flows. When January started, we really anticipated that when I was here at Milken, I'd be telling you that I was net positive significantly in inflows. But the good news is that we're not negative, right? So we are net positive, just not as much as we thought we'd be. But we do anticipate that by the end of the year, we're going to see some real increase to the action that clients are taking to put their money to work. I think right now, they're not pulling back. They're just being cautious, but they're being cautiously optimistic, which I think is really good.
Yeah, I feel like it's a term that we've heard a lot here at Milken, the cautious optimism. Dina, when it comes to private credit, right, we continue to see that market grow. We continue to see the number of participants in it grow. How do you guys differentiate yourself?
Okay, so the private credit word is, the private credit saying is really interesting. We've been doing it for over 2 decades. We believe our edge is that we are research-driven, due diligence-driven, quality over quantity. And one of the things that really genuinely concerns me about how there's been a huge growth in this space is for the new players that are entering it, I'm not sure they really understand the operational demands and the risk oversight that you need when you're actually providing those types of funds and those types of investments to clients. And I do think that it's one thing that Guggenheim differentiates itself in that space is that we do offer a deep bench, not just from the research and the investment side of it, but also from the administration, valuation, liquidity profile, reporting, and the education, right? So our thought leadership is award-winning. And one of the things we truly focus on is really educating the advisors that we service when they are contemplating investing in interval funds, BDCs, and really understanding the differences between them and what that really will mean to their clients' end goals.
Well, when it comes to private credit, in terms of making that differentiation, you mentioned making sure that you have, the risks that are involved. What do you think? Because I feel like everybody has been all in on private credit for many years now as the industry has grown. What are the biggest risks that you kind of remind your team, this is what we've got to watch out for?
Issuer credit quality, right?
Yeah.
Do they have their ability to meet their debt requirements and their covenants? Especially in these uncertain times, I think it's really important to focus on the credit quality. Anything right now, clients really want higher yield, but they also want stability and flexibility. So I think it's tremendously important to make sure that the credit quality is there and understanding their liquidity needs, right? And when they need that liquidity. And I think that will really help you maintain and retain your client relationships if you're being very transparent about exactly what they're buying and when they're going to be able to take money off the table.
There's been a lot of talk at this conference, too, about sort of the democratization of access to private assets, alternative assets, if you will. A lot of partnership between some of the big institutional players as well as some of the alternative asset managers as well, in an effort to sort of, I guess, go a little bit further down the income spectrum in terms of attracting new clients. Is that going to sustain itself?
I think so.
Yeah.
I think that the mass affluent is educating themselves, especially with the application of AI now, which we're really proud of, how we're using AI in our working environment. I think that people have a tremendous opportunity now to get access to some really important information that allows them to invest their money more wisely, not just for their current situation, but for their generational planning and estate planning as well. And these are types of investments that do have long duration with high yield and income benefits if you're investing and allocating in the right way, and diversified. And when I say diversified, it's not just diversifying with the types of issuers, but also the types of products, right? Because they all have different liquidity requirements.
All right, gonna leave it there. Listen, thank you so much. Always finding time for us.
Oh God, I want to spend more time with the two of you.
And she didn't even need her notes. Why did you bring notes?
Because you guys just make me feel so comfortable. It's great.
I had notes too, so don't feel bad.
So good to see you, and I hope to see you again soon.
Thank you.
Always.
I always love talking to somebody who manages more than $300 billion
well, I don't do
in assets. Overseas a team. Yes. Yeah, I misspoke again. Let me just shut up now.
All right. Enjoy the rest of your week.
Thank you.
It's finally sunny in LA. So.
Finally, Dina Dilorenzo, President of Guggenheim Investments.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
PIMCO has a major focus on asset-based finance right now, taking advantage of that opportunity. And its global head of credit research, Christian Stracke, joins us right now here on the Milken stage. Great to see you, Christian.
Thank you.
Talk a little bit about the expansion of asset-based finance, because when I hear about it, I can't help but think, didn't that already exist? Is this an evolution? Is this something new? Explain it to me.
Well, it is an evolution. I mean, it has existed, but mostly it existed where banks would make loans and then securitize them into asset-backed securities. So yes, that has existed for 40 years. What we're seeing more and more, but in that old version, banks would retain real skin in the game, and they would retain a lot of loss exposure when they would retain that part of the securitization. Now, though, banks are going to a model where it's much different, where they're actually selling loans to asset managers like PIMCO and others outright. So they're not securitizing, they're selling the loans outright. There still is some alignment with the asset manager. And that's really the new thing that has happened. That's in the last couple of years, ever since the failures of the regional banks, the Silicon Valley Bank, First Republic Bank, and also Credit Suisse in Europe. You're seeing more and more banks moving to this model of what they're calling velocity of the balance sheet, of turning over the balance sheet, still keeping the customer, still keeping the borrower, and making the loan, but then selling it to an asset manager. Then asset managers take those loans, and then we, PIMCO, we securitize them. And so that way, all of the risk is moved into a much better way of holding the risk, which is not. And the problem with the banks was bank liability deposits.
But I am curious, how do you evaluate that risk in the here and now when there's still just so much uncertainty, if you will, around economic conditions and whether those assets will be able to weather those conditions?
Right, exactly. You have to have pretty deep infrastructure for analyzing the risk that you're taking, because not every loan is made the same. And you have to do stress tests on these loans. And right now we are stress testing for a recession. It is not PIMCO's call that there will be a recession, but we're not going to buy loans that aren't going to be able to survive through a recession. So that would be residential mortgages, or is a pool of residential mortgages going to continue to perform if there's a recession? Consumer loans, equipment loans, aviation finance, things like that. We are stressing for a recession, not our call, but we need to be resilient in the assets that we're buying.
So super picky, it sounds like. So if there's a bundling of them, I mean, everything's on the same grade, in other words, right? We're not getting a mixture in terms of risk valuation.
Well, there are mixes, but PIMCO is really avoiding subprime. And, there's a business to be done in subprime, but it's been our style to be more up in quality. And there's more and more supply of those more higher quality loans coming out of banks. And for us, it's a better risk-adjusted return over the longer term because you don't have those drawdowns and those losses when recessions come.
How quickly are banks moving them off their balance sheets? I'm just curious, like what you are in that process.
Well, if you look at in the years prior to the failure of Silicon Valley and First Republic in 2023, bank loan growth was high single digit every year. In 2023, it was 2 or 3%. In 2024, it was 2 or 3%. This year, year to date is about 3%. So the loan growth has dropped considerably, and that's because banks they're still making them, but they are selling them off to asset managers. So this is very significant. It's in the hundreds of billions now. It's not in the trillions yet, but it will get there, and it's spreading. That's the other thing. We're seeing more and more of it in the UK now. We're starting to see it on the continent as well, because what European banks are realizing is that US bank equity multiples are doing better as they're doing this velocity of the balance sheet. It's good for the bank itself, and so Europeans are seeing that and are taking that opportunity as well. Yeah.
Christian, I do have to get your thoughts about the Fed meeting today. Obviously, rates stayed the same as was expected. Yeah. But there is a lot of questions right now about where rates might go later this year. And I'm wondering, do you have any visibility into that? I mean, I know that ultimately becomes an economic call as well. Yeah. But as you're sort of modeling things out, are you modeling for higher interest rates or maybe just where they are now?
We are modeling for higher interest rates than we would have expected 6 months ago. We are not modeling we're not using as a base case higher interest rates that the Fed would hike interest rates. That is a tail scenario that we do include in our stress scenarios. So we do model that, but it's not the base case. Whereas the recession is, as I say, it's not a base case, but you have to be able to survive through that. Now, the visibility is really, and Rich Clare, our colleague, has spoken a lot about this, is that the base case should be that the tariffs should be a one-off impact on price level, and as long as monetary policy and fiscal policy don't accommodate that, then inflation should get under control over the course of next year. But we do expect that the Fed will be more or less in a wait-and-see mode, and they need to see how this goes and whether that will be the case.
Christian, though, in terms of tariffs, I understand the concept of a one-off, but if that one-off is pretty onerous in terms of what the deal is, that kind of changes the picture.
There's no question that it will have secondary effects. Okay. There will be second-round effects. The question is, will there be third and fourth-round effects? And there it would be, how does the Fed respond to that? And the reality is the Fed will keep rates higher than they would otherwise given a softer economy.
All right, we got to leave it there. Yeah. Never enough time. Thank you.
Yeah, thank you very much.
So appreciate it. Christian Stracke, he's PIMCO's President and Global Head of Credit Research.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A lot going on here, I got to say. BlackRock's Chief Executive Officer, Larry Fink, we want to point out, among those members of the U.S. financial and tech business community that will visit Saudi Arabia along with President Trump next week. It's a big trip. The president is keen for the oil and gas-rich Gulf states to ramp up investments in the U.S. and really buy more of its goods. Now, developments out of that could certainly shape the global investment landscape. Our next guest leads the team that generates investment strategy research across many markets, including global fixed income, liquid corporate credit, alt asset markets such as private credit and real estate. A great overview. So let's bring in Amanda Lynam. She's BlackRock Head of Macro Credit Research. BlackRock, of course, the world's largest asset management firm, $11.6 trillion in assets under management. Got to get it out because, man, there are firms and then there are firms like BlackRock that just see a lot in terms of investor sentiment and where flows are going. What are you guys seeing that maybe we aren't capturing in the narrative?
Yeah, well, thank you so much for having me. Good afternoon. I've been struck by the optimism of this conference. I think one of the things that's really stood out to me is a proactive, almost offensive approach to taking advantage of market dislocations and volatility. I think there was widespread acknowledgement that there's a lot of uncertainty that we need to navigate. We probably haven't seen the last of it. It's very dynamic, as you've been saying, but I was really impressed upon kind of let's take advantage of this to find opportunities for our investors outside of the U.S. As you mentioned, was one of the things as well. Private credit was another.
Right. You're impressed.
Yeah.
Do you buy it? Are you surprised by it?
I do, and I think it makes sense because I think really what I took away from a lot of the conversations over the past 2 days was kind of a back to basics approach to real credit work. Credit is my universe,
right.
And I think there's an acknowledgement there are things we can control, there are things we can analyze, there are things we cannot. Let's make sure that we have diversified portfolios that we can navigate this. But I'm not sensing a risk-off posture. I'm not sensing a retreat. What I'm sensing is, okay, there are opportunities that will come out of this, and how can we make the most of it? I was really pleasantly surprised to see so much emphasis on Europe as an opportunity set. I think on private credit, actually the convergence of public and private credit markets was something that came up a lot in the discussions across a variety of different conversations. The next generation of financing, kind of acknowledging some of the long-term needs for capital. These are all structural shifts that we've been talking about for a while, actually, including bank partnerships with private credit. But it was good to hear them kind of formalized and almost mentioned proactively.
Are they being accelerated because of current conditions?
I think there's a delicate balance, Romaine, of there's a bit of an option value to waiting and seeing. We heard it from Chair Powell. We're hearing it from corporates. So time is of the essence here. We want clarity. We want it soon. I think that will be best for the business community. But I do think actually what there is what I heard yesterday was dispersion is inevitable. And I think you see that in asset classes. You see that in conversations. So I do think there's a recognition that we need to be a bit front-footed.
Well, talk about some of the lower-rated companies in the world of credit, because I know, look, if you're a relatively healthy company with good cash flow and maybe profitability, you're probably not too worried. But if you're a company that's already been struggling, and particularly if you maybe have to face refinancing sometime soon, what should we expect out of those? Is that an investable space right now?
It's a great question. I would say we are comfortable moving selectively down in quality. Sometimes the automatic reflex in a period like this is to move up in quality in a generic sense. We're pushing against that a little bit, going back to the back to basics credit work. The one area we are watching very closely, pockets of the credit market, just like pockets of equities, have already been under pressure before the hard data has deteriorated. I would say the very low end of the high yield spectrum, triple C's, parts of the leveraged loan market that are levered over 7 times, right? You have pockets of these markets that the left tail was already under stress. That's where we're watching. So you can't be reaching too far down in credit risk.
But I'm curious, with regards to the pricing in that part of the market, as well as the potential yield that you're going to get, that's enough to entice people back? And if so, is that just relative to the fact that other areas of financial markets like public equities are down?
Within reason, it's enough. Parts of high yield have actually outperformed investment grade year to date on a total return basis. Part of it is basic. Credit just sits higher in the capital structure. We don't talk about it enough. Part of it is you are picking up an additional spread premium. With the volatility in the treasury market, that incremental credit spread is meaningful. But I think where we would draw the line is reaching too far down the quality spectrum, given the uncertainty, into companies that just aren't viable. That's really the distinction.
I want to go there because I can't tell you how many times I think we've had a conversation since we've been at Milken about people saying, you're going to have to be very selective in private credit. Know your manager. Make sure that So I'm just curious about all those other companies that maybe aren't making the grade. Does that mean you anticipate we will see some fallout, especially when it comes to those firms that just can't find either a way of finding the funding they needed?
Absolutely. The dispersion that we expect in liquid credit also applies to private credit. One of the striking stats that we track, actually private credit fundraising since the Fed started hiking in 2022, the lion's share of it has gone to managers with 4 or more vintages. Why? It's because allocators are valuing restructuring expertise, workout experience, the actual ability to navigate a cycle like this. There will be winners and losers, absolutely, for sure. We see dispersion amongst certain sectors, companies with certain size profiles, but I would say in average, actually, just like in liquid credit, the aggregate fundamentals are still pretty attractive. The technicals are supportive, and I think what I'm sensing from this conference, there's an opportunity cost to being too defensive. It came up yesterday. Someone was basically making the point, I'm hesitant to be too short if there's a really positive potential outcome that's on the horizon, so I need to make sure to kind of navigate that. So I think, going back to your question, Romaine, there's this delicate balance of what is the optimal trade-off between selectively taking risk, maintaining a diversified portfolio, and not being too defensive, because actually the lesson from 2024 was that there was an opportunity cost of being too defensive.
It's a full plate.
Yeah,
it's a full plate.
That's a great point, and that's a great place to end. Amanda, really great to catch up with you. Amanda Lynam, she's the head of macro credit research over at BlackRock.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.